Hi, this is Brad Keithley, Managing Director of Alaskans for Sustainable Budgets. Welcome to the weekly Top 3, the top 3 things on our mind here at Alaskans for Sustainable Budgets for the week of November 24th, 2025. The weekly Top 3 is a regular segment on The Michael Dukes Show. The show broadcasts on both Facebook Live and YouTube Live, as well as via streaming audio from the show's website, weekdays from 6 to 8 a.m. I join Michael weekly in the first hour of Tuesday's show from 6:10 to 7 a.m. for a discussion between the two of us about our 3 issues. We post the podcast of our discussion following the show on the Alaskans for Sustainable Budgets Facebook, YouTube, SoundCloud, Spotify, and Substack pages, also on the Alaskans for Sustainable Budgets website, as well as the project's page on national blog site, medium.com. You can find past episodes of the weekly Top 3 also at the same locations. Keep in mind that in addition to these podcasts, during the week, you can also follow and participate in the discussion with us of these and other issues affecting Alaska's fiscal and economic condition by following us on the Alaskans for Sustainable Budgets Facebook page and through our posts on Twitter. This week, our top 3 issues are these. First, we catch up on some recent developments affecting the Cook Inlet gas market. Second, we catch up on some recent developments related to North Slope oil. And third, we explain the fatal disconnect in what many think is Alaska's trickle-down economy. GDP growth followed by household income growth. It's not happening. And now, let's join Michael.
Let's get started here because this is some interesting stuff. I'm was doing some of the reading last night and this morning, and this whole gas thing is just fascinating. The AKLNG project is worming its way into just about every aspect of our lives, whether we want it to or not. So let's catch up on LNG, Cook Inlet LNG, and give me your thoughts on what's going on here.
Well, there's 2 aspects of Cook Inlet LNG. One is the LNG importation, the importation of LNG to fill the coming gap in traditional production from Cook Inlet gas supplies, and then the big line coming down from the North Slope. That's referred to as Alaska LNG. That's another LNG aspect. So let's break them up into the 2. The Cook Inlet LNG, which I think the importation of LNG into Cook Inlet, which I think everybody, I don't see any dissents from that anymore. Everybody has accepted is going to be there's going to be importation of LNG at least for some period, if not becoming a normal routine part of the Cook Inlet over time. Has taken on some fascinating pieces here in the past little bit. You can see it coming, but it's sort of coalescing into this interesting situation we have. There are 2, notwithstanding the fact we don't need a lot for a fairly long period, because we still have Cook Inlet production. We will still have native Cook Inlet production for a fairly prolonged period. Notwithstanding we don't need a lot, we have 2 Cook Inlet LNG importation projects. One is a collaboration, a greenfield collaboration between NSTAR and Glenfarne to build a brand new spanking LNG importation plant at the location where the LNG export plant would be ultimately if the big line is built. And that is something that's been championed and is underway as a collaboration between NSTAR and Glenfarne. And then there's the second one is one that I've talked about since we started going down this hole of having a gap in Cook Inlet supplies. The second one is the acquisition by Hilcorp of the old Kenai LNG facility, the old ConocoPhillips back in the day, LNG export facility to use as to turn it around and use as an import facility. And that was historically run by Phillips back in the day to use as an export facility. And then as we started hitting the limits of Cook Inlet production, they shut that down. And now it's been acquired by Hillcorp. It was owned by Marathon, acquired it. Marathon, who owns the refinery next door, acquired it to use it to import LNG for its own uses as a fuel at the plant, but never really did that. And so they have now sold it to Hillcorp to be turned into an importation, an LNG import plant at some expense, because you just don't flip a switch and it turns around. You got to make substantial investments. Plus, it's been shut down for a while to turn it into a LNG import facility. And those are both proceeding apace. I think it's the general consensus. I'm sure there are people who would object to this, but I think it's the general consensus. We don't need two. The Kenai LNG facility has some limitations on it, but it's scalable. You can construct additional import, additional regasification facilities, and additional facilities around that. Probably easier than you can the greenfield facility that NSTAR is building. But we have this divide going on, and Nat Hertz did an excellent column on this that's showing up in some of the state's papers, is on Nat's website, Northern Journal. And here is sort of the nut of why we have this divide, why we have two facilities going on. The announcement of the Hillcorp's acquisition of the Kenai LNG plant from Marathon, the announcement underscored an already tense relationship between NSTAR and Hillcorp, the Harvest affiliate. The two companies have been feuding in court over terms of an existing unrelated natural gas supply contract between NSTAR and Hillcorp, and the dispute is what Hillcorp is obligated to deliver on any given day, on peak days, to NSTAR, and that's been the subject of a fairly intense dispute. John Sims, who's the head of NSTAR in Alaska, has said publicly that his company is not interested in participating in a project that could further consolidate the position of Hillcorp, which is currently urban Alaska's dominant supplier to utilities of locally produced natural gas. And what that means is the biggest Cook Inlet producer by far. Right. It's the biggest Cook Inlet producer. So Sims is saying he's not interested, because, in part, substantial part, because of this dispute they have between NSTAR and Hillcorp. He's not interested in participating in this project by Hillcorp. I have problems with Hillcorp having acquired the Kenai LNG plant. When you talk about consolidation of market or concentration in markets, you use something called the HHI index, the Herfindahl index. That's what you use to calculate the level to which a market is concentrated. And the HHIs, with Hillcorp already in the dominant supplier position, the HHIs go off the chart when Hillcorp acquires the Kenai LNG plant. I mean, they're higher than any market concentration you would normally see. And so I have concerns about Hillcorp acquiring, but there are ways to handle that concern. And I wrote a column about this a few months ago in the Landmine. The way to handle that concern is through regulation, because essentially Hillcorp's becoming a monopoly. It will monopolize its position in the Cook Inlet in terms of gas supply with the acquisition of the LNG plant and using it for LNG supplies. And so the way you normally handle a monopoly like that is through regulation. And we have an agency, a regulatory agency that's skilled at doing that, the Regulatory Commission of Alaska, that regulates natural energy monopolies, natural gas monopolies, electric monopolies in the state, but also natural gas monopolies in the state. And it wouldn't be that hard a thing for the RCA to take that on and regulate that monopoly. So there are ways of handling this market concentration concern that's out there with respect to Hillcorp, short of building a second plant. I mean, competition's good, but you don't need to undertake, building a second plant when you've got an existing plant that could serve the demand. So that's a whole issue that I think is going to become more intense the farther we go. I mean, Hillcorp's sinking money, or NSTAR is sinking money into its deal with Glenfarne. It's doing doing site preparation. It's doing work on preparation for what that plant would look like, and so it's starting to sink money into that second plant. I think the RCA needs to, and at one point, Sims said that he would welcome, in this article, he said he would welcome RCA intervention to try to bring some rationality to this.
Yeah.
I think the RCA needs to step in and do that.
Well, this is what struck me about this is, and I understand the concerns about Hillcorp being being dominant and having a virtual monopoly, but you would think that these three utilities could work together to try and figure this out. But instead, Sims, and you just said it, Sims acknowledged as much, said he'd welcome intervention from regulators to encourage closer collaboration. Why do you have to have the regulators come in to let you guys collaborate together? That's the thing. I mean, it makes no sense. Why would we build two $500 million plants when we only need one? What, just they're just not playing together? That's it? I mean, they're just not getting along? What's happening?
Well, I think part of it is Sim says it later in the article that he doesn't trust Hillcorp. Basically, that he doesn't trust Hillcorp. They're not getting along with Hillcorp. Hillcorp's monopolization of the gas supply market is of concern to him, and it should be, but it shouldn't. The answer to it shouldn't be to build a second plant. The answer should be for the RCA, and if it needs additional legislation to do this, and it may, for the RCA and the legislature to step in and say, look, it's great that Hillcorp wants to do this. It's great that Hillcorp has the expertise and feels it wants to step in and be the supplier, but we're creating a monopoly here, and monopolies need to be addressed. I mean, we can't let them run riot, and monopolies need to be addressed, and so we need to have RCA regulation of the Hillcorp Kenai LNG plant. And I think that step removes Sims's argument that we need this second plant because we can't trust Hillcorp. And the RCA is sort of at the center of this. The RCA would be the regulator of the LNG plant, of Hillcorp's LNG plant. The RCA is the regulator of both Chugach, who's pursuing this project with Hillcorp, and NSTAR regulates both of them. The RCA is the one who could knock heads and force the two by disallowing costs. Knock heads, force the two to come together and work on a joint project that achieves lower overall cost for Cook Inlet residents. So it's the RCA is at the center of this. The legislature may need to become part of the solution by giving the RCA whatever powers it feels it lacks to be able to regulate Hillcorp. But that we should not be building two LNG import facilities for at least in the near future for the relatively small size of the gap that we're going to have in the near future.
Well,
one other piece.
Go ahead. No, go ahead.
I was going to say one other piece of the Cook Inlet LNG situation is the AK LNG project and coming down from the slope. And we saw something at a hearing last week that I knew was coming, and we've talked about on the show that it was coming. It just hadn't reared its head yet, but it did last week, and that is the Glenfarne and the proponents of the AKLNG project coming in and asking the legislature for various things that they say the legislature needs to do to protect, to solidify the AKLNG project. What they asked for last week was essentially in the industry what you call an offset provision. You have certain taxes, or you have a certain fiscal structure that on which a project will be predicated, and in the international, this shows up in the international sphere some. In the international sphere, if a project is very tight on its economics, and you're building that project based upon a certain assumption about what the state take is going to be, what government take is going to be, you ask for an offset provision such that if the state would increase taxes, for example, property taxes on pipelines would increase taxes in a given area, the level of state take in a given area, that the statute also provides, that the governing statutes also provide an offset that the government would reduce its take in another area so that the economics of the project would remain the same across the board. It's essentially special treatment of a project that has marginal economics. And I could see this coming, from Glenfarne that they're going to start to ask for things like lower property taxes than the state's property tax rate, various provisions that will enable them to fix their economics, but at the expense of the government's flexibility going forward. And that's exactly what they did last week. So the Cook Inlet has a lot of moving parts going on with it. We need to reduce and simplify the number of moving parts, certainly on the side of the import LNG projects, and get them sort of focused on one that works as opposed to two that will magnify costs. But we also need to be aware that we're starting to see the AKLNG proponents ask for special favors from state government going forward that will shift the burden of risk from the project itself to state government, and shift the economics from a risk economics on the part of the project over to a risk economics on the part of state government.
And this is part and parcel of the whole thing that Glenfarne's been doing. They wanted a surety that if they spent the $50 million earlier, that they get reimbursed from the state. And now they're looking for more surety on this, that if anything changes, not just taxes, but maybe regulatory things that the state may not have any control over, they want to be held harmless from that as well. And I mean, it could be a significant problem.
It's a water drop. I mean, essentially what they're doing, we've talked about this on the show before. They've announced all of these, various letters of intent and potential agreements with suppliers and all of those sorts of things to sort of build up expectation and excitement about the project. Now they're starting to drop in the things they want from the state, the economic certainty they want from the state as we go along. I don't think that project goes, but it's something to certainly be aware of what the state may potentially be signing on to as we go down the road.
I mean, at least they've stopped dithering on whether or not they should import LNG, but now they're going to have a tussle over two different I mean, this makes no sense to me. I mean, it really doesn't. And the fact that we didn't even talk about the fact that NSTAR has now asked the RCA to allow them to bill customers for what, $48 million or something, $50 million to bill customers ahead of time because they have to pay back Glenfarne for some of this other stuff. So they're speculating, and they want the RCA to sign off on them charging customers $50 million more to build this second facility. I mean, this just sounds like a jobs program for Glenfarne, quite honestly.
Yeah. Well, the problem is we're seeing sort of the utility play out of kids squabbling, right? I mean, NSTAR doesn't like Hillcorp for decent reasons. I mean, Hillcorp is Hillcorp reads its contracts in ways different than other people do. Hillcorp is a fairly aggressive operator in terms of its dealings with NSTAR, and NSTAR is reticent to put all of its eggs in the Hillcorp basket. I understand that, but what I don't understand is that then branching off into two LNG import projects, sort of doubling the cost, if you will, of LNG import projects. Because this isn't the way the track we're going on right now. This isn't a one or the other. This is both of them. NSTAR builds one, Hillcorp builds one for Chugach, and we end up with both of them. And so we need the adult in the room to sort of get involved and sort of shake this out. And the adult in the room, we've got an adult in the room, is the RCA. We've set up a statutory scheme where the RCA is the adult in the room over utilities. It sort of looks over their shoulders and makes sure they're doing things right at the lowest reasonable cost for ratepayers. The problem is the RCA hasn't quite stepped in, and the problem also is the RCA may not have all the authority it needs to be able to deal with Hillcorp, and that's something the legislature needs to address. Because as I said, I understand Sims's position that he doesn't want to have to become subject to a monopolist in dealing with this gas supply. I understand that. But we've got solutions for that rather than building your own plant. a second plant. And so we ought to be having hearings, and we ought to be having legislation that addresses that situation, as opposed to just letting it go ahead and fester. Because, if we don't address it in this legislature, we go another year, potentially another 2 years. NSTAR keeps spending money on that second project. They want the recovery of that money. That's the $40 million you're talking about. They want the recovery of that money. If it doesn't get solved in time, they may even start building the damn thing. And then we're really going down the wrong road. So it's something I think that the legislature needs to understand better from the RCA. The RCA needs to be more expressive about the situation it's in. And then the RCA needs to address it as well with the utilities.
I mean, we've been talking about how the RCA has been kind of MIA on this whole thing, right? The whole time they need to be stepping it up. And I just don't see how that's going to happen, and why we would build a second facility for $500 million and then expect the ratepayers to pay it. There was a comment, and I wasn't aware of this. There was a comment. The parallel development efforts represent a significant split among urban Alaskans utilities, which, according to regulators and watchdogs, also drove up costs for consumers by failing to coordinate when they spent $1.5 billion on new power plants and other infrastructure in recent years. Apparently, they weren't talking to each other, so nobody knew. So they built duplicate stuff.
Yeah, that was a split on the electric side between MEA, who built an electric plant, a generation plant for themselves in Chugach. So,
yeah, I mean, I don't understand the competitiveness in that regard. It makes no sense. Okay, we're continuing now. Brad Keithley, Alaskans for Sustainable Budgets, number 2 of the weekly top 3. We just got all kind of catching up with the AKLNG and the Cook Inlet gas. Now it's time to catch up on the North Slope crude, because we keep hearing new stories. Oh, it's going to be great. They're going to start pumping oil in March. It's going to be fun. Oh, wait, we don't get paid for 10 years? Never mind. Brad, what's happening here?
So a couple of things on the North Slope that we need to catch up on. One is the lease sale that just occurred that has made headlines in all the state's newspapers and is touted by the Dunleavy administration as a continuing sign of the North Slope renaissance. And the second is the startup of Pika and the stories, Santos's Pika project, and the stories that we're seeing about all the additional revenues we're going to get out of Pika. The first one, the lease sale was good. I mean, I'm not going to knock the lease sale. We had a number of bids. We had a number of tracks sold. But at the end of the day, it's $17 million. I mean, $17 million is money. But when you look at a state deficit of $1.8 billion, $2 billion, $17 million sort of pales in comparison in terms of being a solution. What we had on the lease sale was a couple of things. One was people are sort of as people are becoming more familiar through Pika and through Willow and through some other exploration activities that are going on up there, as they're becoming more familiar with maybe the trends, the geologic trends that exist on the North Slope and where potential oil is. What you see in part is people filling in holes in their lease position around projects that and in lease areas that potentially may be part of the new trends, or potentially may hold sort of branch offs of the new trends. And so there was quite a bit of that going on. People just sort of filling in holes, leases that are areas that hadn't been previously leased, but looked like they might be part of the trend. Some of it was sort of step out, some of it was people looking at new areas, and the potential that new areas that you might have oil potential in new areas that really weren't part of the current trends. That was a much smaller part of the lease sale, but you have some of that in the lease sale. But you have most of that is by small players, small LLCs that don't even have websites. I mean, I went to look for a couple of these new companies that I wasn't familiar with. And they don't even have websites up describing their company. So those usually are players trying to get in front of a potential play, get themselves a lease position for a relatively low cost, and then they're hoping to be bought out if it turns into something. They may try to finance an exploration well themselves. They may not, but it's really just sort of a bet on the potential of new plays out there, and they're trying to position themselves to get something out of it. Think in the software industry. Think of somebody who develops a new app, hoping to be bought out by Google or Microsoft or Apple. That they're putting a little bit of money in to try to develop the new app, but they're hoping to be bought out by a major player. That's sort of what's going on with part of this. The other thing noteworthy about the sale, again, is that it's focused. The bids were focused primarily onshore on the North Slope. There were some bids in the North Slope foothills, but that's sort of the speculative players that are looking at potential new plays, extensions of existing plays in the North Slope, or other new plays. Not really major players looking at real prospects, just sort of people speculating. And there was a couple of bids out on the state waters offshore, but again, that was speculative players, not really major players who have the financial capital behind them to be able to really pursue projects out there. They're just trying to position themselves to go forward. So, $17 million is $17 million, but it's only $17 million. And so, a lot of people seem to have a lot of excitement about this. Oh, it's a new record, number of players, number of leases sold. Yeah, okay, but it's not huge in terms of, oh my gosh, somebody's identified something that nobody had ever thought about, and there's a rush to get in on that, and there's a lot of money being put in on that. $17 million in the industry, particularly spread out over the number of lease tracks that we have here, is not that big a number. The other thing going on that's making the press, that's going on the North Slope, that I think is worth talking about, is we're seeing a number of articles about. There was one in the Alaska Story, the new Must Read, I'm sorry, I probably shouldn't even say that, Alaska Story. There was an article about, we have Santos's Pikka project about to start. That's going to produce so much revenue. It's going to be great for the state. We need to keep in mind, yes, we're going to get royalty revenue, but we don't get production tax revenue until 2032 out of the Pikka project. Even if the Pikka project starts next year in 2026, we don't get production tax revenue because of the way SB 21 operates. We don't get production tax revenue out of that project until 2032. So yes, we're getting some revenue, and yes, some revenue is better than no revenue, and yes, some royalty revenue is better than no royalty revenue. But the standard we ought to be looking at here is, are we achieving what the Constitution requires, which is the maximum benefit from the development of the state's resources, maximum benefit for the people from the development of the state's resources. And you and I have had this discussion before. We're going to continue to have this discussion over time. I don't think we are. I think we are falling short. The legislature is falling short, and the administration is falling short in not proposing to the legislature, and falling short in terms of not reforming oil production taxes to reflect the system that we've gone into now in the second decade of SB whatever the hell it was, SB 21. Not fully reflecting the economics of what's going on, and having a situation in which a major share of the initial, between now and 2032, Pikka is going to ramp up in terms of production. It's going to plateau for a while, and it's going to be on the downside by 2032. So the major share of initial Pikka production is going to go untaxed, not paying production tax. So I think we have, people are all excited about the additional revenues, and there's a lot of praise of Pikka and a lot of praise of Santos and the development, and all of that's deserved. But there's a shortfall, in my view, between what we're going to get out of that additional production, the substantial share of that additional production, what we're going to get out of that, and the constitutional standard of maximum benefit. And I don't see anybody in any of the articles talking about, measuring what we're getting out of Pikka in terms of the constitutional standard.
Right.
and looking at whether or not we're hitting the constitutional standard on what the state's share of that additional production should be.
You've gone into this in detail, talking about how the production goes, the curve is the production curve goes way up, but our income curve goes down because of those production taxes. And you, as an oil and gas guy, have said many times that we need to revisit this tax structure, but there is such a pushback from everybody involved. Nobody wants to talk about revisiting the tax structure. It's almost as bad as the idea of some kind of sales tax or something, because we just couldn't possibly do that, even though we have a finite resource that's not coming. I mean, we only have so much of it, and yet we're basically, at this point, giving away the farm, especially on the front end of the production, where all the the high production is. By the time 2032, 2034 comes involved, as you said, now it's on the decline. We've already got a declining resource there. I mean, none of this makes sense to me.
Yeah, it's I mean, I don't think I was there at the beginning of SB 21. I was there in the arguments, and the arguments were we need to make an investment. The state needs to make an investment in terms of restructuring oil taxes, lowering the state's oil tax take in order to incentivize additional investment and additional production. And the key part of the argument, a key part of the argument, was at the back end. Once we have this additional production, the state's going to share in the benefits of the additional production by deriving additional revenues that the state otherwise would not get. And so it's a good deal for the state to give up money at the front end by reducing oil taxes. Good deal to make this investment, to attract additional investment, to bring additional production, and then the state's going to share in the benefit at the end. That's not what's happening. What's happening is at the back end, when we're supposed to be sharing in the benefits of this additional production is going up. Production rises over the last 10-year forecast, the spring revenue forecast. Production rises something like 40%, but production tax revenues go down by 40%. And yes, royalties sort of stay the same along the way, but production taxes, which is a big part of the state's revenue share from oil, a big part of how we achieve the maximum benefit obligation under the Constitution. Production taxes actually go down as production volumes are going up. That's not how SB 21 was sold. That's not the intent behind SB 21. The intent was a sharing of sacrifice at the beginning in terms of the state reducing the oil tax burden to incentivize additional investment and additional development, and then a sharing of the benefit at the back end to sort of compensate the state for taking this reduction at the front end. The sharing of the benefit at the back end didn't happen.
I don't even know what to say to this, Brad, because again, we could see the problems, we could see where it's going. And even though Suzanne Downing makes a mention of this, there's really no, she mentions she says, because PICA developers can deduct billions in initial project costs, significant production tax revenue is not expected until around 2034. But royalties and pipeline efficiencies will provide immediate benefits. So she goes on to talk about the jobs and everything else. But the bottom line is that they'll mention it, and then they'll not mention to what extent that affects the state. That's the worst part. It's like they mention it and then they gloss over it and they move on to something else.
Yeah, and there's something. There's this. What they're glossing over is something else. I mean, people say, okay, oil companies ought to be able to recover their costs. And so the fact that they have all these costs they've built up in the development, and that deduction is driving down the state take. Some people say, well, that's okay. That's we ought to let them recover their costs. Now, the problem is they're recovering their costs in a way that's sort of beyond industry standard out there in the world. They're recovering their costs in the first year after they make the expense, after they spend the money. The usual standard out in the world is an amortization over some period of time, so that you recover a little bit of your cost every year. And the other thing is the standard out in the world is mostly ring fencing, so that you recover your cost against the production that the investment's been made to produce. In Alaska, we let them recover the cost against any production. So ConocoPhillips, for example, which has a lot of existing production, is able to reduce the taxes it's paying on other production in the state from the investment it's making in Willow. So there's there's even a little bit of things that we ought to be talking about with respect to recovery costs. But the big thing that's driving the PICA, the not recovering money from PICA for several years, is an artificial thing that was put in SB 21 called the gross value reduction provision. And the gross value reduction provision reduces the amount of revenue that's subject to tax for new developments outside of existing fields. And that was sort of a good thing at the time SB 21 was done, but it's run amok in terms of the impact it's having on production taxes. So it's not just what Suzanne mentions, which is the recovery of costs. It's the GVR provision, the gross value reduction provision, the artificial gross value reduction provision that's sitting on top of those costs that's really driving down production tax revenues. PICA, for example, would be paying a 4% minimum tax from the first barrel of production. 4% minimum tax, even with all their costs, they'd be paying a 4% minimum tax from the first value of production, from the first barrel of production, if it weren't for the GVR provision. It's the GVR provision that is delaying or excusing any production taxes from between 2026 and 2032. So we've done it to ourselves. It's not just not recovery of costs. It is the GVR provision that's sitting on top of the recovery of costs that is creating this this extended tax holiday for new production. That's resulting in production tax revenues going down even as production volumes rise. And that's something we can go in. I mean, the producers can say all day long, oh, we spent this money thinking that we're going to be able to recover it. Okay, fine. We got very liberal provisions about how you recover it, but let's set that aside for a later discussion. Let's talk about the GVR provision and the artificiality that the legislature introduced in SB 21 with the GVR provision. And let's reform that so that at least you pay minimum tax from the first barrel. At least you don't get excused from any tax.
And the GVR change, of course, the legislature could make a simple change with that in and of itself in isolation and fix part of this problem, is what you're saying.
Yep. Just go back to minimum tax. Just take the tax holiday that GVR creates, take that tax holiday off, and just make sure that every barrel at least pays a minimum tax. Right now, we're not doing that, and that's a big part of the effect of production volumes going up while production taxes are going out. It's a big driver of production taxes going down.
And why do you think nobody else is talking about this aberration here, Brad? Why is nobody else talking about it?
Because it's complicated, and you actually have to spend time figuring it out, and you have to actually understand the industry a little bit to figure it out. And we don't have a lot of people in government who understand the industry. We don't have a lot of legislators who understand the commercial aspects of the industry. So it's just complicated. You got to figure it out. And the industry says, hey, you wrote rules. We relied on the rules. Don't change the rules on us as we go forward with the production. And people go, oh, okay.
Okay. All right. We'll just do what you say. We're continuing now. Brad Keithley, Alaskans for Sustainable Budgets, and the weekly top 3. We're ready to get into it. We're on to the number 3, which is a discussion which I'm sure will make all of our eyes glaze over, but it is super important, right? I mean, Brad, I was just asking Brad, why don't some of these things get fixed? And he's like, because it's complicated. And everybody wants to, basically everybody wants to talk in sound bites. Nobody wants to do the homework and have to get down into it. But this is the stuff that we need to be talking about. All right. So Brad, inflation versus income. There's some real issues here. Brad, just give it to me. I know I'm setting Brad up for some bad stuff here. Give it to me, Brad. What do we?
You had the right words in there. You had inflation and income and real and sort of all that stuff. So I've been spending some time trying to better understand what's going on with Alaska income, with income to Alaska families, and the measure I've been using for that is real in the economic sense, which means after inflation. You take inflation out, so you can compare years better that way. You're not having inflated numbers as a result of inflation only. real median Alaska household income, and I use median. There's two measures of average Alaska household income. One is mean, which is the average, and the other is median, which is the midpoint. There's an equal number of incomes above and households above and households below. It's the median. And the reason you use median is because mean, the average, the arithmetic average of mean, is heavily influenced if you have a number of high income families or a number of low income families. It will pull the average up or down away from the median. The median is a much better measure of what's the average Alaska family experiencing. Mean is really distorted by a cluster at the top or a cluster at the bottom. So median really is a much better reflection of what the average Alaska family is experiencing. And I've been looking at that, just sort of stunned, because the real, after inflation, median Alaska household income has not changed virtually since 1984. I mean, it has gone up and down a little bit, but if you scale it on an index, with 100 being what we had in 1984, it's not changed real after inflation. It's not changed much in 2024. Over the 40 years, it hasn't changed much. And if I did another calculation starting in 2020, and it doesn't change much from 2020, it just stays. Other states have had an increase in their real median household income. If you look at the states, the outmigration states that Alaskans are going to, if you look at Washington, Oregon, Texas, Florida, the states that Alaskans are out migrating to, all of those have had an increase in their real income. If you look at the northern tier states that Alaska is often measured against, Montana, the Dakotas, Idaho, all of those have had an increase in real median household income. Alaska's just stayed stagnant. And then I've looked at GDP, gross domestic product, which is the measure of the output of the economy, and economic growth, what some people refer to as economic growth in the economy. And Alaska's GDP has gone up over that period, but real median Alaska household income has stayed relatively static. So it's a fascinating. I've got a chart, Michael, if you can throw it up quickly, that looks at this since 2020. The dotted line is GDP, and as you can see, GDP has gone up. It went up toward 2006, and then it's sort of stuck at that level. This is real again after inflation, but it's sort of stuck at that level since 2006. But it's elevated significantly. It's gone up 50% over the 20 years between 2020, 24 years between 2020 and 2024. It's gone up 50% over that period of time. The solid line is real median Alaska household income, and you can see it's on an index. It starts at 100%, at 100 on the index in 2000, and it's back to 100 in 2024. It hasn't changed. I mean, it's gone down sometimes when the cost of living, when inflation's been high. It's gone up sometimes for various reasons, but over the span of that 20 years, it hasn't, or 25 years, basically, it hasn't changed, even as GDP has gone up. So there's some issues in here that we need to understand, because Alaska used to have a very strong household income compared to other states. It used to be the strongest in the nation, and it's gradually deteriorating over time by just running in place as other states have real growth, and as Alaska GDP has grown. And we need to understand why that is, because the real measure of how Alaska is doing, how Alaska families are doing, is household income, and whether the households in Alaska are growing, having a growing share of income, a growing share of wealth, and we're not. Even as our GDP, even as the overall state output, real GDP, inflation adjusted GDP, even as real GDP is growing. Why aren't Alaska families benefiting getting the benefit of some of that growth? Why aren't they growing in the same time frame that GDP is growing? A lot of answers for that. It's interesting to ask Chat GDP or any of the other AIs that question and see the answers you get. There's a lot of things that are going on. Part of it is the GDP growth is in oil, and that's really a capital intensive growth, a growth based upon capital investment. And so the returns, the benefits of that growth are going to capital. They're going to the people who invest, the equity owners. It's going to the debt holders in terms of the repayment of debt. It's going back to the companies in terms of recovery of depreciation. It's not flowing to Alaska families, and so that's part of it. Part of what's going on. There are other things going on. One thing that shows up consistently when you start studying this is the influence of the permanent fund dividend. And the discussion is that the permanent fund dividend is a sort of a unique way that Alaska found to tie GDP growth to capital, to income growth, by distributing a portion of the benefits realized from GDP growth, or a portion of the benefits realized from oil revenue growth, down to families. The cut in the PFD is having an impact on keeping Alaska household income flat, even as we see the benefit of oil and revenues from oil and the GDP generated by oil increasing. So something that's I'm going to be writing about a lot more, something I'm going to be talking about a lot more, but this is sort of the basics to begin the discussion about why we are having this diversion and why Alaska households are remaining static over time as the rest of the nation and as Alaska GDP and as overall GDP grows. Why are Alaska households remaining static over that period?
And how much of this is also combined to the fact that we're paying more attention to the private sector or the public sector than we are the private sector, right? I mean, how big of a factor is that? 45 seconds here as you wrap up, Brad.
Yeah, part of it is that because it's not the payments to the public sector or expenditures by the public sector don't necessarily reflect in household income. They reflect benefits generated to households, but not in household income. So that's part of it as well.
Yeah. I mean, you look at this and you can just see that money is not trickling down into household income. I mean, the money is stuck, and as you said, whether it's in repayment or capital intensive things, or whether it's going into government spend and not being reflected in the direct income of the households. This is another red flag right here.
It is, and it's. I mean, Alaskans, generally speaking, I don't think Alaskans feel like they're making progress. I mean, some sectors do; those tied to the oil industry do. Some tied to the government services industries do. They feel like they're making progress, but the average Alaskan that I talk to really doesn't feel like they're making progress. And so when I start looking at average household income as a way of trying to get at that issue, I see why they don't think they're making progress. Cost of living is taking. I mean, if you look at non-inflation adjusted median household income, it's going up. But the reason it's staying flatlined on a real basis is because the cost of living increases are taking all of that benefit out. So Alaskans are just treading water. The average Alaska family is just treading water over time. They see benefits they see headlines that say, hey, there's benefits in terms of additional oil development. There's benefits in terms of additional investment, but they're not seeing that in their pockets. They're not seeing that flow into the average Alaska household. And I sense a lot of frustration about that. And you start looking at the numbers and you see why that is. I've got a chart that I'm going to publish either this Friday or the next Friday that breaks this down by income bracket. Actually, the low income, the low 20%, the lowest quintile, is losing on a real basis. Their income isn't going up enough even to offset inflation. They have a negative real growth. The middle income brackets, the lower middle, the middle, and the upper middle, are sort of gaining a little bit against inflation, but not much. The top 20% is gaining a lot, and the top 5% is gaining a huge amount. So, to the extent we have money flowing into to Alaska household income or Alaska households, it's flowing mostly into increasing the income gap between the upper incomes and the middle and the lower income. So it's a fascinating subject once you start digging into it and understanding the numbers that are reflecting what's going on with the Alaskans, the Alaska household economy.
But wait, Frank says it's because of their spending choices. They're not seeing growth because of their spending choices. But
what?
But if they're not even keeping up with inflation, what does the spending choices matter at that point, right? And Corey says now we're being asked to pay additional taxes to offset what the government won't stop spending, and that's again another thing. They won't control what they're doing, so I mean we have to pony up even more.
Yeah, but this is the income side. I mean, spending has nothing to do with it. This is the income side, and what Alaskans are receiving in income. It's a whole different calculation when you start talking about disposable income and all that sort of stuff. But this is just the basic income side, what Alaskans are receiving in income, and their income isn't growing. Their real after cost of living, their real income isn't growing. What you're seeing, what you see in the headlines is, oh, the economy's growing, the GDP is growing, or there's more oil industry jobs. Well, those are high paying jobs, and yes, you are seeing growth in the high paying jobs. You're seeing their trend line going up, but the median Alaska household is not seeing any growth at all after cost of living. So it doesn't matter what they're spending it on, that has no impact. It's the income side. We're not seeing the income to the real median Alaska household going up.
And that's a problem. Harold says you're finally on his side. I mean, you've been talking about been talking about reforming the oil taxes and giveaways since SB 21, but now you're finally on his side. I just wanted to let you know that in case you were worried about that. It's fine.
That actually bothers me.
Yeah. All right. I'm sorry. It does matter when we're paying utilities and groceries, the cost of living, and additional taxes impact. Yeah, and I understand that, Corey. I understand what you're saying there. Definitely, we're all feeling it. But what Brad's whole point here is that even just the base income, before we get to expenses or what you're spending or anything else, is that we're not even keeping our head above water in that regard, and there's a problem there. And I think a part of it is, again, the oil taxation and the growth and explosive growth of government over the last 20 years.
Yeah, and oil taxation is two parts. One is oil taxation, getting your fair share out of the oil industry, getting the maximum benefit as required by the Constitution out of the oil industry. But it's also it's also whether that shows up in Alaska household income, and that the only way we're really transferring the benefits of oil into the median Alaska household, into the average Alaska household, is through the PFD. So if you're cutting PFDs, even if you increase oil taxes, if you're cutting PFDs, that's not going to translate into the average Alaska household income. That's the mechanism where Alaska had genius over an extended period of its history, of its oil history, translating some of that economic growth in GDP back into household income. And now we're losing that genius by transferring, by taking that income, instead of putting it to households, putting it into government.
Right, where it doesn't show up for everybody. Brad Keithley, Alaskans for Sustainable Budgets, the weekly top three. We'll see if we could talk Brad into hanging with us for a minute to talk about Thanksgiving, because I feel good about that. We'll see what happens. Brad, thank you so much for coming on board and hitting the weekly top three with us. We appreciate it.
Michael, as always, thanks for having me.
Folks, we got to go. We're going to be back with more of the Michael Duke Show.
Well, that's a wrap for another week's edition of the weekly top three from Alaskans for Sustainable Budgets. Thank you for joining us. Remember that you can find past episodes on our YouTube, SoundCloud, Spotify, and Substack pages, and keep track of us during the week on Facebook and Twitter. This has been Brad Keithley, Managing Director of Alaskans for Sustainable Budgets. We look forward to you joining us again next week on the weekly top three.